Hello, everyone, and welcome. Today, I want to discuss a topic that I think is really important, but it did happen a little while ago, and that's the Federal Reserve meeting at Jackson Hole. This year is very important to us because it's a turbulent year for inflation and for the market, and we want to find out what the Federal Reserve is doing. Something that's important to note, though, is that this happens every year. This isn't a once in a lifetime thing where the Federal Reserve has this meeting. The Kansas City Federal Reserve puts this on every year. So this isn't different than normal because of the circumstances, but we want to take an important look at it this year because we want to know what the Fed's going to do in the future. That way we understand what's going to happen in maybe the stock market with the Federal Reserve rate and even inflation. So let's go ahead and take a look into that. Okay, so the first piece of data we have here is the money supply that the Federal Reserve has released. And what we want to look at with this is to see what's happened over the last few months, even the last 2 years, to understand why we're in this situation that we're in. So we'll go ahead and change this to 5 years. And also I'll leave a link for this data below so you guys can check this out for yourselves. So we're looking here, we're seeing we go through 2018, 2019, and everything's relatively flat. We're really not creating a lot of money supply. But here you can see where it has the recession. This gray mark here is a recession that the U.S. economy was in, which you guys know about in 2020. And then we see this large spike in the money supply from April to May. That's because the Federal Reserve began to increase their money supply in order to make sure that there wasn't a recession during this downturn. That caused inflation to rise later in the year, but we can discuss that more in a minute. But as we look here, we can see it continues to go higher until about here in March of 2022. And now we're seeing it slowly coming down. We're going to look at another chart here in just a moment to see what's actually going on with the supply and look at the Fed's balance sheet. And we're also going to look at the Fed funds rate to get a better idea of what's going on with all of that. But this is the amount of money that the Fed printed. And look how drastic of a change it is. We went from 4.7 trillion to 16.2 trillion. That's a really large jump in a very short amount of time. Next, we're going to take a look at the balance sheet for the Federal Reserve. So as we discussed in the previous section, we talked about the money supply greatly increasing. You can see the same trend right here where the Federal Reserve really upped their balance sheet amount, which means they were buying stocks, bonds, and other securities to make sure that those markets didn't completely crash. So though we did see a downturn in them, I think most of you would also remember the large increase we had in things like the Dow, the S&P, and just stocks in general, moving upward after the initial downturn in 2020. So as we see here, they took a little bit of a break and they've been going consistently ever since then. But more recently, in about March of 2022, the Fed decided that they were going to decrease their balance sheet. So let's take a look here in just the last year. So though we do see this increase, and it is a small increase here comparatively to in 2020, we get here to about April. So they talked about doing this in March, and yeah, you can see here where they did move down a little bit. And then April 13th is really where the climax is for the balance sheet in the Fed. As we see, they continue to lower it down month over month. And now we're in this Fed policy where we're going through quantitative tightening, which is whenever they start to lower the balance sheet, decrease the money supply. And we'll see that on both of those charts. Now we're going to move over to the Fed fund rate to talk about what's going on there and why those correlate with these past two charts. So now we see the federal funds rate. This rate is what the banks use with each other to do the overnight lending, which we can talk a little bit more about, but just a brief overview of that is if one bank needs to meet their liquidity limit, they will borrow the funds from another bank, and this is the interest rate they use, and it's just a short-term loan, just literally one night usually. So this is the Fed rate for that, and it really determines a lot of interest rates that we see. It also is a status used to determine what the Fed is trying to do with their policy. So, as an example, during the 1980s, the Federal Reserve decided that the inflation rate was too high when it was getting to double digits, 10, 11%, and that they needed to lower that back down to around 2%, which is their usual goal. So, what they did was they raised interest rates to very high levels. Here's an example of 17.61, 19%, 19% again in July of 1981. And that allowed us to have a recession, which most of the time we think, man, recessions aren't good. But in this case, the recession was okay. It was a tough landing. It was not this gentle landing that the Federal Reserve is currently talking about. But it ended up getting us back on track to have that 2% inflationary rate, which is what the Fed really wants to keep prices stable. As we can see, that's not what is happening in 2020, in 2022, and so on and so forth in the 2023. So let's make this chart a little bit smaller. As you can see here, in 2020, they really dropped the rate down to around 0%. And now they're starting to raise the rate again since March of 2022. We are seeing three things with this. Number one, they're raising the federal fund rate. Number two, they're lowering the money supply. And number three, they are lowering the assets on their balance sheet. So let's go back to the camera and we'll discuss these last 3 points. So we just looked at three different things. We just looked at the Fed fund rate, the federal balance sheet, and the Fed's money supply. We just saw that they're raising the Fed fund rate and they're lowering the money supply and their balance sheet. That's something important to look at because these are key highlights to what the Fed's policy is going to be. And right now, that's quantitative tightening. What that means is I'm expecting them to continue to raise their federal funds rate. They're going to continue to decrease their balance sheet and their money supply. And that's going to cause large, I think, pains for our current economy. But what does that mean for us? So what that means for us, I think the Fed is going to continue to raise interest rates. I think they're going to continue to take assets off their balance sheet. And I think they're also going to continue to lower the money supply. That's what we've heard from Federal Reserve Chairman Jerome Powell in the past, and I think that's going to continue to be what his goals are. Also, we need to pay attention to what they're doing here with these indicators. They're sending a clear message that they want to do quantitative tightening. What that means for us as regular investors and as personal finance people. Number one, be careful on loans. Try not to take out debt if you don't need to, because I think the interest rate is going to be high for these loans, comparatively to the past couple years. Another area to think about is the stock market. The Fed is too large to fight. You don't want to be going against them. As they're taking money out of stocks and bonds, it's not necessarily the best time to be putting money into there. But you can decide for yourself what's best for you. Right now, what I'm doing is I'm doing my consistent investments into the market because I think it's more important to be in the market than to try and time the market. I don't know when the Fed's randomly going to stop trying to invest or take money out of the market. You don't know when they're going to start investing into the market. So right now, I think it's best for me to just continue to be invested in the market. What I am going to do, though, to try and help with this downward trend is I'm going to be selling covered calls on my stocks. I want to try and get the premium to try and make up for some of the losses that I'm making. And if I lose the shares because the stocks go up, that's fine. That's really okay for right now. I just want to try and, mitigate some of that risk of the stock market going down with selling some covered calls. Now, we haven't discussed covered calls on this channel yet, but if you guys want to hear more about that, go ahead and hit the like button, subscribe, and comment below so I know that you guys want to talk about that. I want to try and talk about subjects that you guys want to know more about, so definitely leave a comment below so I know. Also, next week, I'm going to be going to an event called Workiva Amplify, which is in Las Vegas, Nevada. I'm really excited to get the opportunity to go to this event and learn more about this program. So if you guys want to know more about it, go ahead and leave a comment below. But I'm going to be doing a couple videos next week on Wednesday and maybe even a Friday video on what this conference was like, because this is what most companies are now using to create their financial statements. So I want to give you guys a background on what that's like and how they're doing this and what it's like for main players in the market to be using this program. So stay tuned for that, and I'll catch you guys later.